$13 trillion. That is how much the world's governments have stockpiled inside sovereign wealth funds, the largest collection of state-controlled capital in human history. Most people assume these funds exist to invest oil money wisely, to grow a national retirement portfolio. What almost nobody realizes is that these same funds are now buying farmland on 4 continents, taking over the world's largest food trading companies, and financing bypass pipelines around active war zones, all because of the one crisis that money alone has never solved: keeping populations fed when global supply chains collapse. From $4 trillion in 2008 to over $13 trillion by 2025, sovereign wealth has grown at a pace that dwarfs most private financial institutions, with projections placing total assets at $17 trillion by the end of this decade. The question nobody is asking loudly enough is whether this concentration of state capital is making nations more resilient or engineering a new kind of global inequality, where the richest countries buy their way out of food crises, while the poorest scramble for whatever remains. Sovereign wealth funds did not arrive fully formed. They evolved through 3 distinct generations, and each one reveals something different about how governments define survival. The earliest iteration, SWF 1.0, were passive stabilizers. Kuwait's investment authority opened in 1953, and Norway's government pension fund Global followed the same playbook decades later, both designed to prevent Dutch disease. When a country discovers massive oil reserves, foreign currency floods in. The domestic currency climbs so high that manufacturing dies and agriculture shrinks. These 1.0 funds countered the problem by parking surplus petrodollars in diversified international portfolios. When commodity prices crashed, managers liquidated those external assets and sent cash back to the national treasury. The approach worked, and it required almost no creativity. That changed with the 2008 global financial crisis. Emerging economies watched developed market assets collapse overnight and asked a harder question: what good are trillions in foreign reserves if domestic infrastructure remains broken? The answer created SWF 2.0, the capacity builders. Nigeria's Sovereign Investment Authority committed over 50% of its portfolio to local healthcare, power generation, and agriculture. India's National Investment and Infrastructure Fund anchored deals that pulled in foreign institutional capital. When crisis arrived, these funds jumped directly into rescuing domestic banks and financing public works to keep people employed. COVID-19 tested every assumption. An estimated $211.3 billion flowed out of 33 funds across 27 countries, the most aggressive wave of sovereign interventionism ever recorded. And here is what mattered most to global bond markets. Countries with rules-based fiscal frameworks saw borrowing costs run 350 basis points lower than nations without them. Even when governments temporarily broke their own rules to fund pandemic spending, capital markets treated the institutional architecture as a credible signal, and fiscal deviations historically snapped back within 3.5 years. None of that prepared anyone for what followed. The collision of pandemic supply chain wreckage, the 2022 Ukraine conflict, and the 2026 Middle East maritime crisis forced a third evolution. SWF 3.0, the Strategic Resilience Funds. $1 trillion in the bank means nothing if the ships carrying grain and fertilizer cannot sail. Gulf states responded by tasking subsidiaries like Saudi Arabia's Salik and Qatar's Hassad Food with locking down entire agricultural value chains from field to domestic port. The playbook now demands physical control over tangible commodities, not just financial exposure. The acquisitions happening under this playbook are staggering in scale. Abu Dhabi's ADQ, sitting on $110 billion, secured 167,000 hectares in northeast Sudan for sesame, wheat, cotton, and alfalfa. Its conglomerate Al Dara controls another 118,000 hectares across Romania, Serbia, Egypt, and the United States. The deal tying the strategy together was ADQ's 45% stake in the Louis Dreyfus Company, structured with contractual agreements guaranteeing the UAE priority food shipments during global supply disruptions. Saudi Arabia's public investment fund channeled $13 billion into agriculture through SALIC, operating 200,000 hectares of grazing land in Australia and 195,000 hectares in Ukraine for wheat, barley, maize, and rice. Between 2020 and 2023, SALIC imported 4 million tons of strategic commodities into the kingdom. The 2022 numbers tell the story. SALIC covered 30% of Saudi wheat demand, 720,000 tons directly, plus 600,000 through subsidiaries, alongside 120,000 tons of barley, 70,000 tons of soybeans, 13,000 tons of red meat, and 11,000 tons of rice. The boldest move came with SALIC's progressive takeover of Olam Agri, a major global agribusiness player. December 2022 brought a 35.43% initial stake for $1.24 billion, followed by agreements to acquire the remaining 64.57%, opening a clear path to complete sovereign ownership of a company carrying a $4 billion total equity valuation, reflecting a 14% premium over the 2022 price and a 3.47 times price-to-book multiple. Qatar followed an identical logic, taking a 14% position in Adecco Agro, and its nearly 500,000 hectares across Argentina, Brazil, and Uruguay, while Hassad Food locked in majority control of Sunrise Foods International for guaranteed access to organic grains and oil seeds. Every one of these acquisitions serves the same strategic function, bypassing the global spot market entirely. Own the farm, the processing plant, the shipping vessel, and the domestic storage silo, and you hold a sovereign call option on physical food security that no speculative price spike can take away. The payoff showed up during the inflationary shock of 2021 and 2022, when supply chain fractures collided with the Ukraine war, and outcomes split along sovereign wealth lines. Food CPI in the United States climbed 8.8% between March 2021 and March 2022, part of a broader inflation surge that reached 40-year highs at 7%. The Gulf Cooperation Council told an entirely different story. Regional average inflation in late 2021 hovered at 2.2%. By late 2022, the range ran from 6.5% in Qatar down to an actual deflationary reading of negative 0.4% in Bahrain, where transport costs declined 2% year over year because domestic fuel prices never moved under rigid state price controls. Global vector autoregressive models spanning 1987 through 2022 confirmed the pattern. International commodity price shocks barely pass through into GCC consumer prices because state subsidies, funded by sovereign wealth, absorbed volatility at the border. SALIC fulfilled wheat contracts at subsidized internal rates, severing the link between domestic food costs and global exchange swings. Al-Marai, a Saudi food corporation, pulling 64% of revenue domestically, posted 18% revenue growth in 2022, despite global agricultural commodity inflation, combining 3% volume gains with strategic price adjustments and maintaining EBITDA margins between 20 and 22%. That performance during a global food price crisis only happens when the state absorbs imported inflation through its sovereign balance sheet. The architecture runs deeper than price fixes. The most disciplined SWFs tie drawdowns to mathematical triggers, not political judgment. The SOM rule fires when the 3-month unemployment average rises 0.5 percentage points above its 12-month low, and binding SWF liquidity to that kind of statutory trigger gets emergency capital into the real economy within weeks, bypassing gridlock entirely. During severe economic slack at the zero lower bound, the fiscal multiplier can push well above 1, meaning every dollar of sovereign drawdown generates more than a dollar of economic activity. For all the engineering, sovereign food interventions carry a brutal track record of failure when the strategy ignores physical reality. Saudi Arabia spent decades proving this. During the 1970s and 1980s, the kingdom directed as much as 50% of hydrocarbon income toward turning desert into wheat fields, and price supports at multiples of global market rates somehow made Saudi Arabia the world's 6th largest wheat producer by the early 1980s. The achievement destroyed ancient fossil aquifers that took millions of years to form, generated massive rent-seeking, and became a permanent fiscal hemorrhage. Domestic wheat production finally ceased in 2016. Qatar learned a similar lesson faster. The National Food Security Program opened in 2008 with $1 billion and a target of 70% food self-sufficiency by 2013. Absolute water scarcity and the immense cost of desalination killed those targets within years, forcing repeated downgrades before the initiative was quietly shut down and replaced by overseas investment through Hassad Food. Overseas acquisitions bring different costs, and those fall hardest on host nations. Ethiopia leased a 300,000-hectare concession to Karoturi and 10,000 hectares to Saudi Star. The Anuak and Nuer tribes in the Gambela region lost ancestral territory without compensation because rural farmers held no formal ownership titles. Foreign operations consumed fertile land and water without integrating local agriculture, and deforestation stripped away the ecological safety nets communities depended on during droughts. $11.5 trillion in state capital invites what economists call the multi-level principal agent problem. Citizens own the wealth, but delegate to politicians, who hand authority to SWF boards, who pass decisions to fund managers. Each layer introduces misaligned incentives, and politicians facing electoral cycles routinely push for investments, delivering visible short-term wins that violate the fund's long-term mandate. Kazakhstan's national fund became a case study in this decay. $1 billion for real estate market support in 2009, $2 billion in 2014 to absorb toxic bank loans and finance the Expo 2017 complex, and an enormous $16.3 billion between 2020 and 2023. Analysts calculated that, without these politically directed withdrawals, the fund's assets could have climbed past $262 billion. And warnings now circulate that continued drawdowns may threaten the structural integrity of the national budget by 2026. Malaysia's 1MDB, gutted by centralized control and zero independent auditing, produced one of the largest kleptocracy cases ever prosecuted. Libya's investment authority, holding $62.85 billion in assets, shows actively managed portions consistently underperforming sections frozen under UN sanctions. One London property sat empty 10 years, hemorrhaging $79 million in lost rent. The Santiago Principles, 24 voluntary guidelines drafted by 26 founding SWFs in 2008, were designed to solve these failures through transparency and operational independence. For a decade, the bargain held. Geopolitical fragmentation is now dismantling it. FDI screening regimes and financial sanctions mean that even strict Santiago compliance no longer guarantees market access, and calls within the IFSWF for a complete reformulation are growing louder. Every model of sovereign resilience now faces a live test. The Strait of Hormuz closure has trapped 20 million barrels per day of crude behind the conflict zone, 25% of global seaborne oil trade. Brent broke past $80, Oman crude spiked to premiums exceeding $160, and models project prolonged conflict could push prices past $130, inflicting GDP losses of $770 billion to $2.2 trillion. Gulf SWFs are running the full 3.0 playbook. Saudi Arabia's Petroline to Yanbu and the UAE's ADCOP to the port of Fujairah represent the only functional bypass infrastructure. But combined capacity of 3.5 to 5.5 million barrels per day falls far short of replacing 20 million. Sovereign wealth is being redirected to fast-track pipeline expansion, including a proposed joint GCC line to the Arabian Sea. Mubadala has joined the U.S.-led Pax Silica framework, a $250 million initiative backed by consortium partners managing over $1 trillion in assets, securing critical minerals and semiconductor capacity. The longer-term threat sits in a different category. 30% of seaborne urea and nitrogen fertilizer shipments are bottlenecked behind the strait, and without fertilizer, crop yields collapse within a single growing season. The Herfindahl-Hirschman Index, designed to measure market monopoly concentration, now quantifies food import dependency risk. Any nation sourcing critical calories from too few trading partners faces a vulnerability that no financial reserve can offset. Synthetic control studies found Trinidad and Tobago's Heritage and Stabilization Fund contributed an extra $5,104 in real per capita GDP annually, compounding to over $107,000 per capita in cumulative welfare gains across 3 decades. Countries with well-capitalized SWFs consistently show lower GDP volatility. The paradox sits right beside those numbers. The financial power enabling rapid crisis response also creates conditions for systemic mismanagement and the quiet weaponization of food security. A sovereign entity controlling a global commodity trader can redirect grain shipments toward its own ports, centralizing food access for the wealthiest while deepening scarcity for the poorest. Norway, publishing real-time portfolio values and voting records across 7,000 companies, operates as the global governance benchmark. Singapore's constitutional two-key system blocks the executive branch from accessing past national reserves without independent presidential authorization. Chile's structural balance rule mechanically deposits windfall revenue into the SWF during booms and permits drawdowns only during verified busts. Treating sovereign wealth as a discretionary political instrument, as history has shown in Kazakhstan, Libya, and Malaysia, structurally guarantees capital destruction. Climate change is accelerating agricultural disruption. Geopolitical fragmentation is fracturing the trade routes that kept global food affordable, and sovereign wealth funds are growing larger and more active with each passing year. The question facing every government on Earth is no longer whether the sovereign shield will be deployed. It already has been. The only question left is whether it remains a shield or whether the nations that built it will turn it into a sword.